Imagine this. You're at the top of a hill, holding a tiny snowball. You give it a push, and as it rolls down, it gathers more snow, growing larger and larger until it's massive. Now, instead of snow, picture this snowball being made up of dividend payments from your portfolio. As these payments come in and get reinvested, your portfolio grows exponentially, creating a financial snowball that can provide you with a steady income for life. Sounds intriguing? It should be, because by the end of this journey, I'm going to reveal how you can build a portfolio that pays you $5,000 a month, helping you retire on your terms. But here's the twist. This isn't about striking it rich overnight. It's about harnessing the power of time, patience, and smart investing to create a passive income stream that can support you long after you've stopped working. Stick with me, because I'll be sharing the exact stocks and funds that can help you achieve this goal and 2 different strategies that will generate you $5,000 a month. Why dividend investing? Let's address the elephant in the room. Why should you care about dividend investing in the first place? I mean, there are so many investment strategies out there. Why focus on dividends? Well, let's break it down with a simple analogy. Imagine planting a tree that not only grows over time, but also bears fruit year after year. This tree doesn't require you to chop it down to enjoy its benefits. Instead, it continues to produce fruit consistently. Dividend-paying stocks are like that tree, and the dividends are the fruit. You don't have to sell off your investments to reap the rewards. They keep providing for you, month after month, year after year. Now, here's where it gets even better. Unlike the fruit tree, which produces the same amount of fruit each season, dividend-paying stocks have the potential to increase their payouts over time. This means that not only do you get regular income, but that income can grow as the companies you invest in grow and become more profitable. But how do you build a portfolio that turns this strategy into a reliable income stream, capable of paying you $5,000 a month? That's what we're going to explore next. Understanding the power of compounding. The dividend snowball effect is one of the most powerful concepts in investing, and it's surprisingly simple. When you invest in a company that pays dividends, you have the option to reinvest those dividends to buy more shares of the company. More shares mean more dividends, and more dividends mean more shares. This cycle continues, compounding your wealth over time, just like a snowball rolling down a hill, gathering momentum and size. Let's bring this concept to life with an example. Imagine you start with an initial investment of $1,000. This investment is in a solid, dividend-paying stock that offers a 5% annual dividend yield. At the end of the year, you receive $50 in dividends. If you reinvest those $50 to buy more shares, you'll receive even more dividends the following year because you now own more shares. This might not seem like a big deal at first, but here's where the magic happens. Over time, this process of reinvesting dividends accelerates the growth of your portfolio. The longer you keep at it, the more powerful the compounding effect becomes. What starts as a modest $1,000 investment can grow exponentially, turning into a significant source of income over time. But how does this translate into real money? Let's consider a more detailed example to illustrate the power of compounding and reinvesting dividends. The power of time and patience, 2 investment strategies. Here's the key takeaway. Dividend investing isn't about striking it rich overnight. It's about planting seeds today and letting them grow into something substantial over time. Warren Buffett, one of the greatest investors of all time, once said, "Someone is sitting in the shade today because someone planted a tree a long time ago." This quote perfectly encapsulates the essence of dividend investing. It's about starting early, being patient, and allowing your investments to grow naturally over time. Let's look at 2 different investment strategies to illustrate this point. Strategy 1. You make a one-time investment of $1,000 and let it grow for 25 years. Strategy 2. You invest $200 every month consistently for 25 years. At first glance, Strategy 1 seems like the easier, less demanding approach. You invest a lump sum, set it, and forget it. However, Strategy 2, which involves consistent, smaller investments over time, can yield significantly better results. Why? Because Strategy 2 takes full advantage of the compounding effect. By consistently adding to your investment, you're not only increasing your principal amount, but also giving your dividends more opportunities to be reinvested. This snowball effect accelerates your portfolio's growth, especially in the later years. Let's break this down even further with some numbers. Real-life example: AbbVie and the magic of compounding. Let's dive into a real-world example using AbbVie, a company known for its consistent and reliable dividends. If you had invested $1,000 in AbbVie 25 years ago and reinvested your dividends, that initial investment could have grown to almost $30,000. But if you hadn't reinvested your dividends, your investment would only be worth around $4,600. That's a massive difference, and it all comes down to the power of compounding. But what if you had invested more? Let's say you invested $10,000 instead of $1,000. After 25 years, that investment could be worth nearly $300,000, providing you with over $3,000 a month in dividends. This is the power of letting your money work for you over time, growing and compounding without you having to lift a finger. Now, imagine if you had been investing consistently over those 25 years. If you had been investing $200 every month in AbbVie or similar dividend-paying stocks, your portfolio could be even larger, and your monthly dividend income could easily surpass $5,000. But how do you pick the right stocks to achieve this kind of growth? And how do you build a portfolio that can sustain this level of income? Let's dive into the details. Building the ideal portfolio. The right mix of stocks and funds. To build a solid dividend portfolio, you need a mix of reliable dividend-paying stocks and funds. This mix will provide you with the stability, growth, and income you need to reach your goal of $5,000 a month in dividends. Here's where to start. Dividend aristocrats. These are companies that have been increasing their dividends for 25 years or more. They're stable, established businesses with a history of rewarding their shareholders. Some examples include Coca-Cola, Procter & Gamble, and Johnson & Johnson. These companies provide a strong foundation for your portfolio, offering both stability and steady growth. Dividend aristocrats are like the bedrock of your portfolio. They're not the most exciting stocks, but they are dependable, which is exactly what you want when building a portfolio designed to last for decades. High dividend ETFs. If you want to diversify without picking individual stocks, consider adding high dividend ETFs to your portfolio. These funds hold a basket of dividend-paying stocks, giving you exposure to multiple companies. Some of the best options include SPDR S&P Dividend ETF, yields around 2.9% with a 10-year average return of 10.23%. Vanguard High Dividend Yield ETF, yields about 3% with a 10-year average return of 10.45%. Schwab US Dividend Equity ETF, yields around 3.7% with a 10-year average return of 14.61%. High dividend ETFs are a fantastic way to gain exposure to a broad range of dividend-paying companies without having to pick and manage individual stocks. These funds are managed by professionals who carefully select stocks based on their dividend-paying potential, allowing you to enjoy the benefits of diversification with ease. Dividend-paying REITs, real estate investment. Trusts, REITs, are another great addition to your portfolio. These companies own and operate income-producing real estate and are required to distribute at least 90% of their income as dividends. This makes them an attractive option for dividend investors. Some top REITs include Kimco Realty Corp., yields of 3.26%, Brandywine Realty Trust, yields of 6.59%, Brookfield Property REIT, yields of 7.54%. REITs give you exposure to real estate without the need to buy physical properties, and they provide a steady stream of income through dividends. They are particularly attractive because they allow you to benefit from the real estate market's growth while also enjoying high dividend yields. Putting it all together, a portfolio to retire on. Now that we've discussed the components of a strong dividend portfolio, let's put it all together. To build a portfolio that can pay you $5,000 a month in dividends, you need a strategic mix of dividend aristocrats for stability and consistent growth. Let's say Johnson & Johnson with a 6.28% return. High dividend ETFs for diversified income. For example, Schwab US Dividend Equity ETF with 14.61%. Dividend-paying REITs for high-yield real estate exposure like Brookfield Property REIT with 7.54%. By consistently investing and reinvesting your dividends, you can build a portfolio that not only grows in value but also provides you with a steady income stream during retirement. This portfolio should be tailored to your risk tolerance and financial goals, but the principles remain the same. Focus on quality, consistency, and reinvestment. The journey to financial freedom. Here's the real beauty of dividend investing. It's about more than just money. It's about creating financial freedom. The freedom to retire when you want, to live the life you've always dreamed of, and to enjoy your golden years without worrying about money. By starting now and letting the power of compounding work for you, you can create a financial snowball that keeps rolling, gathering momentum, and providing for you long after you've stopped working. The earlier you start, the bigger that snowball will be. And remember, the snowball effect is slow at first. It takes time for your investments to build momentum. But once they do, the growth can be astonishing. It's a marathon, not a sprint, and the rewards are worth the wait. So if you're serious about securing your financial future, start building your dividend snowball today. Whether you're starting with $1,000 or $10,000, the key is to begin and to stay consistent. Over time, you'll see the fruits of your labor, and you'll be able to enjoy the financial freedom that comes with a well-constructed dividend portfolio. Dividend investing is a strategy that rewards patience, consistency, and smart decision-making. It's a journey that can lead to financial independence, allowing you to retire on your own terms with a steady, reliable income stream. So, don't wait. Start building your snowball today and watch it grow into something truly extraordinary. Thank you for watching, and don't forget to subscribe for more videos on how to become financially free. And if you're serious about dividend investing, I recommend watching this video next from our playlist, Best Strategies to Live Off Dividends on the Moneymaker channel. As always, take care and see you next week.